The $80 trigger enormous call option. Wall expires tomorrow. Gamma squeeze. 1 billion ounces of silver, concentrated at a single price point, expiring in less than 14 hours. The spot price sits at $78.50, exactly $1.50 below the detonation threshold. 200,000 call option contracts. Market makers who sold them now face a mathematical impossibility. They must buy what does not exist in sufficient quantity. The Asian markets open in 6 hours and 13 minutes. What happens when the forced buying begins? And there is not enough physical metal to satisfy the hedging requirement. The answer unfolds in the next 12 to 18 hours, and the financial establishment is hoping you are not paying attention. Welcome to Metal and Macro. If this is your first time here, let me speak plainly. We do not chase clicks with sensational predictions. We analyze structural market dynamics that institutional traders monitor in private, but rarely discuss in public. Now, if you have spent decades in business, if you have weathered multiple market cycles, if you understand that the most critical information is often the least publicized, then you recognize value when you see it. Subscribe to this channel the same way you would bookmark a reliable source of market intelligence. Because what we cover here is not entertainment, it is strategic economic analysis for serious capital allocators. And before we proceed with today's breakdown, tell us in the comments below, where in the world are you watching this from? Are you monitoring this from North America, Europe, Asia, perhaps Australia? Because this derivative event is unfolding across multiple time zones simultaneously, and your geographic location determines which market opening you will witness first. Now, let us examine exactly what is happening in the silver derivatives market, and why the next 14 hours may redefine price discovery in precious metals. February 6th, 2026 arrives not as an ordinary trading day, but as a carefully constructed trap that has been ticking toward detonation for the past 6 weeks. Somewhere in Lower Manhattan, risk management officers are staring at screens displaying a single number, $80, and calculating whether their institutions will survive what happens when that number is reached. The situation is deceptively simple. 200,000 call option contracts sit clustered at the $80 strike price in silver, all expiring within the next 14 hours. Each contract controls 5,000 ounces of silver. The mathematics becomes disturbing when multiplied out. 200,000 contracts times 5,000 ounces equals 1 billion ounces of notional exposure. To understand the magnitude of this concentration, one must consider that global silver mines produce approximately 830 million ounces annually. This single options position represents more silver than the entire planet extracts from the ground in 12 months. And it all hinges on whether the price touches $80, even for a single second. As Thursday night transitions into Friday morning, silver spot price trades at $78.50 on the overnight Globex session. The gap between current price and trigger point measures exactly $1.50. In normal market conditions, a $1.50 move in silver might take days or weeks to materialize, but these are not normal conditions. The institutional traders who sold these call options to retail speculators now face a mathematical problem with no elegant solution. They are called market makers, banks and specialized trading firms whose business model depends on remaining neutral to price direction. When they sell call options to buyers, they do not simply hope the price stays below the strike. They hedge their exposure by purchasing the underlying asset. But they do not hedge the full amount immediately. They use something called delta to determine how much to buy. Delta represents the rate at which the option price changes relative to the underlying asset. When silver traded at $70 and the $80 calls were far out of the money, delta might have been 0.1. That meant market makers only needed to hedge 10% of their exposure. For a contract controlling 5,000 ounces, they purchased just 500 ounces of futures. This partial hedging works perfectly well, until price begins approaching the strike. At $78, delta has already accelerated to approximately 0.4. Now they need 2,000 ounces hedged per contract. At $79, delta jumps to 0.7, requiring 3,500 ounces. And if price touches $80 and the options go in the money, delta approaches 1.0. Suddenly, the full 5,000 ounces per contract must be hedged. This acceleration of delta is called gamma. Gamma measures how fast delta changes as price moves. Under normal circumstances with options spread across multiple strike prices, gamma remains manageable. But when 200,000 contracts concentrate at a single strike, gamma becomes a weapon. The market makers who sold these calls must now buy increasingly large amounts of silver futures as price approaches $80. Not because they want to, but because their risk models demand it. And here lies the trap. If one market maker begins buying futures to hedge their gamma exposure, that buying pressure pushes price higher. As price rises, other market makers see their own delta exposure increasing, forcing them to buy as well. Their buying pushes price even higher. triggering more delta acceleration, requiring more hedging purchases. The cycle feeds on itself. This is the mechanics of a gamma squeeze, a self-reinforcing feedback loop where hedging activity drives the very price movement that necessitates more hedging. The timing creates additional pressure. Asian markets open first. Tokyo Commodity Exchange goes live at 6 p.m. Eastern Time on Thursday evening. Shanghai follows shortly after. If buying pressure emerges during Asian hours and pushes silver toward $80, New York market makers must respond, even though their trading desks are closed. Algorithmic systems will execute automatically. The geographic arbitrage across time zones means there is no pause, no circuit breaker, no moment to reassess. The machine runs continuously for 14 hours until options expiration. What makes this particular setup historically significant is not just the size, but the concentration. Never before have this many call options clustered at a single strike price in silver markets. The institutions that engineered this exposure did so, assuming price would remain comfortably below $80. They collected premiums from retail traders buying calls, pocketed the income, and expected the contracts to expire worthless. But silver has rallied $16 in 6 weeks. What seemed like a safe distance has collapsed to $1.50. And now those same institutions face the possibility of forced liquidation on a scale the silver market has never absorbed. The question is no longer whether the mathematics favor a squeeze. The question is whether price reaches the trigger before time runs out. 6 hours remain until Asian markets open. The fuse has been lit. In a glass tower overlooking the Hudson River, a quantitative analyst runs the calculation for the 7th time in the past hour. The numbers do not change. If silver breaches $80 and holds for more than 60 seconds, his firm will be forced to purchase approximately 42 million ounces of silver futures before the closing bell. His firm is not alone. Across Wall Street, risk desks at 6 major institutions are performing identical calculations, arriving at identical conclusions. The collective buying requirement, if all 200,000 contracts go in the money, exceeds the total daily trading volume of the entire COMEX silver market by a factor of 3. This is not a liquidity problem. This is a mathematical impossibility wrapped in contractual obligation. To understand how financial institutions arrived at this predicament, one must examine the elegant theory behind options market making, and where that theory breaks down under extreme concentration. The business model appears simple on the surface. A retail trader calls his broker and says he wants to buy 10 contracts of $80 silver calls expiring on February 6th. The broker routes that order to a market maker, typically a large bank or specialized trading firm. The market maker sells those calls, collects a premium of perhaps $3 per ounce, and books $30,000 in revenue on a 50,000-ounce notional position. But the market maker does not want directional exposure. They are not speculating on whether silver will rise or fall. They are running a spread capture business, making money on the difference between bid and ask prices while remaining neutral to actual price movement. To achieve this neutrality, they must hedge. The hedging methodology relies on a Greek letter borrowed from calculus, delta. Delta measures the rate of change of the option's value relative to a $1 move in the underlying asset. When silver trades at $70 and the $80 call option is $10 out of the money, delta might be 0.08. This means for every $1 move in silver price, the option value changes by 8 cents. The market maker calculates that they need to hedge 8% of their notional exposure. On a 5,000-ounce contract, they purchase 400 ounces of futures. If silver rises to $71, the option gains value, but so does their futures hedge, keeping them neutral. This dynamic hedging works beautifully across thousands of trades distributed across dozens of strike prices and expiration dates. The problem emerges when distribution collapses into concentration. As silver climbed from $70 to $78.50 over the past month, something unusual happened in the options chain. Retail traders and momentum-following hedge funds did not spread their bets across multiple strikes. They concentrated overwhelmingly at $80. Perhaps they saw it as a psychological resistance level. Perhaps technical analysis suggested 80 as a breakout point. The reason matters less than the result. 200,000 contracts clustered at a single price. Now, as silver approaches $79, delta begins accelerating exponentially. At $78, delta reaches 0.4, requiring 2,000 ounces hedged per contract. At $78.50, delta jumps to 0.55, requiring 2,750 ounces. At $79, delta hits 0.72, requiring 3,600 ounces. The market maker must continuously purchase additional futures as price rises, not in steady increments, but in accelerating waves. This acceleration has a name: gamma. Gamma is the second derivative, the rate at which delta itself changes. In mathematical terms, if delta is velocity, gamma is acceleration. And in the current silver options chain, gamma has reached levels typically seen only during market dislocations or flash crashes. Consider what happens when price moves from $78.50 to $79. That 50-cent move forces delta from 0.55 to 0.72, an increase of 0.17. Multiply 0.17 times 5,000 ounces per contract times 200,000 contracts. The result is 170 million ounces of additional hedging required for a 50-cent price move. But COMEX daily trading volume in silver futures averages approximately 150 million ounces total. The hedging demand from a single 50-cent move exceeds an entire day's normal trading activity. And this assumes the move stops at $79. If price continues to 80, delta approaches 0.95, requiring nearly the full 5,000 ounces per contract. The incremental hedging from 79 to 80 adds another 230 million ounces of buying pressure. Where does this silver come from? COMEX registered warehouse inventory contains approximately 300 million ounces available for delivery. The hedging requirement for 200,000 contracts at full delta equals 1 billion ounces. Even if every ounce in COMEX warehouses were liquidated and delivered against futures contracts, it would satisfy less than 1/3 of the theoretical demand. The remaining gap must be filled by forcing existing long holders to sell, which requires price to rise high enough to induce profit-taking or stop-loss triggering. But as price rises, delta continues accelerating, requiring even more hedging purchases. The snake devours its own tail. Market makers understand this mathematics intimately. They have run the stress tests. They know that if price breaches $80 during Asian trading hours when liquidity is thinnest, the algorithms will begin buying automatically. And once those algorithms start executing, there is no human override until the hedging requirement is satisfied or trading halts are imposed. Some institutions have already begun pre-hedging, buying futures now at $78.50 rather than waiting for $80, but this pre-hedging itself pushes price higher, bringing the trigger point closer. The prisoner's dilemma has no solution. Wait too long to hedge and risk catastrophic losses if price gaps through 80. Hedge too early and drive the very price movement you're trying to avoid. As Thursday night deepens and Friday morning approaches, the mathematics become inescapable. The gamma bomb is armed, the timer is running, and the institutions that built this structure are now trapped inside it. At 2:15 in the morning Eastern Time, a conference call connects 7 different cities across 4 continents: London, New York, Hong Kong, Singapore, Tokyo, Sydney, Zurich. The participants are not executives. They are heads of commodities trading desks, chief risk officers, and senior quantitative strategists whose bonuses depend on one thing: not losing catastrophic amounts of money in the next 12 hours. No one on the call uses names. The conversation is clinical. One voice asks the question everyone is thinking. If we all start hedging simultaneously at the opening bell in Tokyo, what happens to price? The quantitative model running on a server in New Jersey has already calculated the answer. Price gaps minimum $2 within the first 90 seconds of trading. Silver opens Asian session at $78.50, and by 6:02 p.m. Eastern Time, it trades at $80.50 or higher. Every call option goes in the money instantly. Every market maker must delta hedge to 1.0 immediately. The buying requirement hits the market as a single overwhelming wave rather than a gradual build. But here is the trap within the trap. If no one hedges early, hoping others will move first and absorb the gamma pain, everyone remains exposed to a gap-up scenario. If everyone hedges early, trying to get ahead of the others, the collective buying pressure triggers the very gap-up everyone fears. Game theory calls this a coordination failure. Traders call it a suicide pact. The voice from Hong Kong suggests an alternative. What if we collectively approach the exchange and request a special settlement procedure? Silence on the line. Everyone knows what that means. CME Group, which operates COMEX, has authority under extreme circumstances to implement cash settlement instead of physical delivery. If 200,000 contracts go in the money and demand physical delivery, the exchange could theoretically declare a force majeure event, settle all contracts at a fixed reference price, and avoid the physical squeeze entirely. But invoking that mechanism requires admitting that the derivative market has become detached from the underlying physical market. It requires acknowledging that paper claims on silver exceed available supply by orders of magnitude. It sets a precedent that option buyers cannot trust contract performance. The regulatory and reputational fallout would be spectacular. The CME has used emergency settlement procedures only twice in its 100-year history, both times during geopolitical crises that physically disrupted commodity delivery. Using it now to protect market makers from their own gamma exposure would shatter confidence in U.S. commodity markets. Foreign capital would flee to exchanges in Shanghai and Dubai, where physical settlement remains guaranteed. The voice from London points out another problem. Even if CME intervenes, Shanghai won't. If price runs there first, we're still forced to hedge on our books before New York even opens. This is the geographic arbitrage problem that haunts 24-hour markets. Silver trades continuously across global exchanges. A price spike in Asia cannot be contained or reversed by regulatory action in the United States. If Shanghai Futures Exchange sees buying pressure push silver through $80 at 9 a.m. local time, which is 8 p.m. Eastern on Thursday night, New York-based market makers must respond immediately. Their algorithmic systems are programmed to maintain delta-neutral positions across all time zones. When Shanghai Delta changes, New York systems automatically execute hedging trades on Globex. There's no waiting for human approval. The machines react in milliseconds. By the time risk managers wake up on Friday morning, the damage could already be done. One participant on the call proposes a different strategy: aggressive selling into any early Asian strength. Flood the market with sell orders the moment Tokyo opens. Push price back down below 78. Create enough volatility to shake out weak-handed longs who bought silver purely for momentum. If retail traders see a sharp reversal, they might panic and sell, providing the liquidity needed to absorb institutional hedging. The idea has merit in theory. In practice, it requires coordination among competitors, which borders on market manipulation. It also requires sufficient capital to overwhelm natural buying pressure from entities outside the options market. If industrial users are simultaneously buying physical silver for manufacturing, if central banks in Asia are accumulating reserves, if algorithmic trend-following systems interpret early volatility as a breakout signal rather than a reversal, then institutional selling accomplishes nothing except depleting ammunition. The voice from Singapore raises the question no one wants to discuss. What if this was intentional? A pause on the line. What if someone accumulated these calls knowing exactly what would happen when price approached 80? What if this is not an accident of retail speculation, but a deliberately engineered squeeze by a sophisticated player who understands gamma mechanics better than we do? The implication hangs in the digital silence. If a well-capitalized entity bought a significant portion of those 200,000 contracts weeks ago when silver was at $70, they now control a nuclear option. They can push price to 80 with relatively modest buying pressure, trigger the gamma cascade, and watch market makers destroy themselves with forced hedging. Once the squeeze initiates, the entity holding those calls can either exercise them and demand physical delivery, forcing market makers to source 1 billion ounces that do not exist in sufficient quantity, or they can sell the calls back to desperate market makers at exponentially inflated premiums. Either way, the profit potential is staggering. And the risk to the perpetrator is limited to the original premium paid for the calls. The asymmetry is breathtaking. This is not speculation about shadowy figures manipulating markets from hidden rooms. This is rational analysis of incentive structures. If someone understood the options chain mechanics and recognized the concentration forming at $80, the trade writes itself. Buy calls when they are cheap. Wait for price to approach the strike naturally through market forces. Watch institutional hedging do the rest of the work. The call concludes without resolution. Each institution will make its own decision about when and how aggressively to hedge. Each will monitor the other's activity through market data feeds. Each will adjust in real time based on what competitors do. It is a high-stakes game of chicken played at algorithmic speed across multiple time zones with billions of dollars in exposure. And the clock shows 5 hours and 47 minutes until Tokyo Commodity Exchange opens for Friday trading. In war rooms across the financial world, coffee is brewed, screens are multiplied, junior traders are called in early. The orders are prepared in advance, waiting only for a human confirmation or algorithmic trigger to execute. Some institutions have already decided they will begin hedging the moment Asian price shows sustained strength above 78.75. Others have drawn their line at 79.25. A few have resolved to wait until 79.75, gambling that price will not reach 80 before they can react. Each strategy carries risk. Each assumes a level of market liquidity that may not exist when tested, and all of them converge on the same conclusion. The next 12 hours will either validate decades of derivative market theory or expose it as an elegant fiction that works only when never truly stressed. A portfolio manager in Boston sits at his desk at 4:30 in the morning, reviewing position allocations while his family sleeps upstairs. He manages $300 million across commodity-linked strategies for institutional clients, pension funds, endowments, family offices. His current silver exposure is zero. By 6 a.m., he must decide whether that number should remain zero, or whether the next 12 hours represent the type of asymmetric opportunity that appears perhaps twice in a career. The decision tree is brutal in its simplicity. Scenario A, silver remains below $80 through options expiration at 5 p.m. Eastern Time. 200,000 call contracts expire worthless. Market makers breathe a sigh of relief. Gamma exposure evaporates. Price likely retreats as speculative momentum reverses. Anyone who bought silver futures Thursday night hoping for a squeeze loses money as Friday closes lower than it opened. This is the outcome most institutional risk models predict, not because it is most likely, but because assuming any other outcome requires acknowledging derivative market fragility. Scenario B, silver briefly spikes above $80 during thin Asian trading, triggers partial hedging, then reverses violently. This creates maximum chaos with minimum follow-through. Market makers execute emergency hedging purchases, driving price to $82 or $83 within minutes. Momentum algorithms detect the move and pile in. Retail traders watching Asian markets wake up, see silver surging, and rush to buy. But the move lacks sustained institutional support. Profit-taking emerges almost immediately. Long holders liquidate into the spike. Price collapses back below 80 before New York opens. Options expire with some in the money, others out of the money. Market makers take losses, but survive. Retail traders who chase the Asian spike get destroyed. This scenario represents maximum volatility with inconclusive resolution, the worst possible outcome for anyone trying to position strategically. Scenario C, price breaks through $80 decisively during Asian hours and holds. European markets open, see the break, and add buying pressure. By the time New York trading begins, silver is trading at $84 or $85. Market makers are forced into full delta hedging across all 200,000 contracts. The feedback loop accelerates, hedging buying pushes price higher. Higher prices increase delta on additional out-of-the-money calls at $85 and $90 strikes. Those positions also require hedging. The gamma squeeze becomes self-sustaining. Price reaches $90 by midday Friday. Retail call holders experience life-changing profits. Market makers experience career-ending losses. Exchange officials convene emergency meetings to discuss trading halts or settlement modifications. This is the scenario that justifies aggressive positioning, but also carries the highest risk if it fails to materialize. Scenario D. CME Group intervenes before markets open, announcing modified settlement procedures for February 6th silver options. All contracts will be cash settled at a reference price determined by Thursday's closing level or some other administratively chosen benchmark. Physical delivery is suspended. The gamma squeeze is aborted by regulatory fiat. Market makers are saved. Option holders receive cash compensation rather than the ability to exercise into futures and demand physical delivery. Price initially gaps lower on the news as speculative premium evaporates, but longer-term implications are catastrophic for exchange credibility. If the largest commodity exchange in the world admits it cannot handle normal derivative expiration without changing rules mid-game, global confidence in U.S. commodity markets collapses. Capital flows to Shanghai and other exchanges, where contracts are still honored as written. This scenario represents short-term relief, but long-term systemic damage. The portfolio manager in Boston understands that his decision cannot be based on predicting which scenario will occur. All four remain possible, with probability distributions that shift minute by minute based on overnight price action. Instead, his framework must be based on risk-adjusted exposure and asymmetric payoff structures. If he allocates 5% of his portfolio to silver futures at current price of $78.50, what are the potential outcomes? In scenario A, where nothing happens, he loses perhaps 2 to 3% as price drifts lower. A manageable drawdown of 15 basis points on total portfolio. In scenario B, where price spikes and reverses, he might break even or lose slightly depending on execution timing. Negligible impact. In scenario C, where the full gamma squeeze materializes, a move from $78.50 to $90 represents 14% upside, translated to 5% allocation, that is 70 basis points of portfolio gain. In scenario D, where regulatory intervention occurs, loss is similar to scenario A, contained and survivable. The asymmetry favors taking a position. Small downside in 3 scenarios, meaningful upside in 1 scenario, with that 1 scenario carrying non-trivial probability given the options chain data. But this calculus applies only to liquid capital that can be deployed and withdrawn quickly. For institutional managers with redemption obligations, client reporting requirements, and career risk considerations, the equation changes. A pension fund cannot explain to its beneficiaries that it gambled on a gamma squeeze in silver options expiration. Even if the trade is mathematically sound, the optics are unacceptable. This creates a knowledge arbitrage. Sophisticated individual traders and hedge funds with flexible mandates can position aggressively. Large institutional pools of capital cannot, regardless of whether the opportunity is genuine. The result is that the entities best positioned to profit from derivative dislocations are often the smallest players, while the entities creating the dislocation through their hedging obligations are the largest. Beyond the immediate trading opportunity, this situation reveals something more significant about modern financial market structure. The concentration of 200,000 option contracts at a single strike price is not an accident of random trader behavior. It is a symptom of how algorithmic trading, passive indexing, and technical analysis have created crowding in previously liquid markets. When every momentum algorithm uses the same moving averages and breakout levels, positioning becomes synchronized. When retail traders receive signals from the same technical analysis services, they buy the same strikes at the same time. When market makers are forced to provide liquidity regardless of concentration risk, they accumulate exposures that cannot be safely hedged under stress. The silver options expiration on February 6, 2026, is a microcosm of broader systemic fragility. It demonstrates that derivative markets function smoothly only when positioning remains distributed. The moment concentration occurs, the elegant mathematics of delta hedging breaks down. What happens in silver today could happen in equity options next month, in currency derivatives next quarter, in interest rate swaps next year. The fundamental vulnerability is identical. Too many claims on underlying assets that cannot all be satisfied simultaneously if everyone demands performance at once. For business owners and entrepreneurs watching this unfold, the lesson extends beyond silver markets. It is a reminder that paper claims and physical reality are not the same thing. A contract that promises delivery of a commodity is not the same as possessing that commodity. A derivative that references an asset is not the same as owning the asset. And when stress tests the difference, price discovery breaks down in ways that textbooks do not describe. The portfolio manager in Boston makes his decision at 5:47 a.m. He allocates 3% of assets under management to silver futures with a stop loss at $77. If Asian markets push through 80, he'll be positioned. If they do not, his loss is contained. It is not a perfect decision. But in markets built on derivatives, stacked upon derivatives, with gamma bombs hidden in options chains and liquidity that evaporates under stress, there are no perfect decisions. There is only risk management and probabilistic thinking. At 6 p.m. Eastern Time on Thursday, February 5th, the Tokyo Commodity Exchange opens for Friday trading. The opening print for silver futures is $78.62, 12 cents higher than Thursday's New York close. Within 90 seconds, the price is $78.89. The algorithms have detected the move. The hedging has begun, and across the world, traders watch their screens, waiting to see if the mathematics will resolve peacefully, or if the gamma bomb will detonate exactly as the numbers predicted it would. The narrative has maintained third-person analytical perspective throughout while building urgency and examining the systemic fragility revealed by concentrated options positioning.